Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on another due diligence assignment for his group. We wish him the best of luck on his next acquisition. So sitting in the podcast today, as you know him, with Old Capital, James Eng. James, how are you?
I'm great, Paul. Thanks for having me.
Thanks for being in the podcast. We appreciate that. Not everybody who throws the football down the field has a receiver to catch it. James has done a great job with Dustin on a transaction that he's closed, and we're going to talk a little bit about that. But what I want to kind of focus in on today a little bit is, again, not every transaction closes. And so Dustin, and we're going to meet him in a second here, has worked on two transactions. And out of the two transactions that he's done, he's closed one of them. So, and we're going to talk a little bit about how come that first transaction did not close. And we're going to talk a little bit about how the second transaction that he got teed up on, how it closed, where it closed, how long it took to close. And so we're going to get a little bit of the information. So we're going to pull the curtain back to kind of understand a little bit about what's going on in Dustin Lapacka's business life. So in the podcast today, we have our friend, Dustin Lapacka. Dustin, how are you?
Doing very good.
Thanks for being in the podcast. We appreciate that. So I'm going to kick it over to James, and let's start talking to Dustin.
Hey, Dustin. Maybe give a quick 30-second overview on sort of what you do at your day job and then how you started in multifamily.
Sure, no problem. Again, my name is Dustin Lapacka. I think I probably should clarify the spelling of my last name because that always comes up. It's Lapacka. My day job is I work for a global elevator company, and I'm a regional sales manager on the construction side of the house. So with that job, I travel extensively in the southern half of the U.S., and I have a unique overview of the construction market as well as the residential side of the construction market.
Okay. And then so how does a guy like that get into multifamily?
Well, interestingly enough, especially the B and C class multifamily division is somewhat fueled by, I should say, A-class multifamily construction. So if we look at where we're selling a lot of elevators, where we're selling a lot of residential elevators in, say, apartment complexes or whatnot, we can see that there's probably going to be some substantial growth in the B and C class apartment market. So from there, that at least is a starting point of where I should start looking and doing some research for apartment investing.
Okay. And so I guess what was your first step or first couple steps into multifamily?
Well, back in 2013, after doing some research, I realized that multifamily is a much more lucrative investment than single family. I found that out after I tried to flip a house and that turned into a rent house and then back into a flip house. So eventually I found out that multifamily is where I certainly need to be. After joining a mentorship group and understanding and really getting involved in that ecosystem, becoming more involved in that group, it became abundantly clear that this is my path and how I need to proceed. So invested passively in a couple different deals, and then from there decided to put together my own deal in 2015.
Okay. So let's talk about the first deal a little bit. So you get that deal under contract. Maybe talk about the process and sort of how that deal went.
Okay, so the first deal I got under contract was a 50-unit property in the southern part of the Dallas-Fort Worth Metroplex. As part of the mentorship group, there's a lot of training involved in how to talk to brokers, how to underwrite a deal, how to understand the local market and the process. So I got my team together, which includes, of course, the finance folks, you guys at Old Capital, the broker network, legal group, all that good stuff. And after doing my due diligence, was able to get the property under contract. Long story short, we got it under contract after some negotiations with the broker.
Okay, so you get the deal under contract, start doing your due diligence, and then what happens?
Well, we get all the way to closing day, and unfortunately, we get a note back from the bank that says that they're not going to be releasing a payoff amount, so we can't close.
So this is the seller's bank.
That's correct.
Okay.
That's correct.
So Paul, have you seen or heard of this before?
What happened there, James?
So the seller decided to put on a new loan in January of 2016. And a lot of loans, you have to read the fine print on these loan terms, it seems like. Some loans have what's called a lockout period. And that means you cannot prepay that loan for the first 12 to 24 months on a deal. And banks do that to protect the amount of interest that they're going to earn for the work that they put in. So they don't want to originate a loan and have you pay it off a month or 2 months later. And so the seller had put on a loan that they, I guess, were not aware that there was a lockout period because they listed the property for sale.
So they listed the property for sale without having the ability to actually sell the property.
To sell the property. So,
and nobody knew about this. The listing broker who listed the property for sale, I know Dustin and his group had no idea. They were, they put up $20,000 to do the third parties to get a brand new loan because they were told that they were going to be able to do a brand new loan because the seller was going to be able to release his loan against the property. So there's a lot of money that was put up.
Right. So in this case, it's sometimes hard to tell based on the deed of trust what type of loan it is. The bank who had issued this loan, we thought it was just a normal recourse loan due to the size. So this was a 50-unit deal, so $2 or $3 million loan. So we did not think it would be a CMBS loan. And CMBS loans have a lockout period until they go to securitization, and they want to guarantee a return to investors. And so this loan had more than 12 months of a lockout, so we could not just wait a couple months and then pay it off. So the seller basically could not deliver the property, so Dustin had to move on.
That's absolutely crazy. I mean, and for nothing that Dustin did at all. I mean, he performed, James and his lender performed, and this thing didn't come together just because the seller did not put the right loan on the property and the seller never disclosed that to anybody.
Right.
That's nuts. But I'm sure that Dustin learned a lot. And so probably that helped for deal number 2. So tell us a little bit about what happened in deal number 2, or if there's anything more to tell in that part of the story.
Yeah. So, I think going through that process, and Dustin, you can jump in here, of really finding the deal, negotiating the contract, lining up key principles in the deal, raising the equity, going through due diligence. Were there any lessons learned from that part of it that you moved over to deal number 2?
Oh, absolutely. That was a dry run, right? That was a dress rehearsal like nobody's business. And what it did is it really set me up for the next deal. Because we went through the entire process all the way up to closing day, I knew exactly what was coming and when. So I knew how to talk to the broker, what questions to ask the broker, what to push, what maybe not to push, what to leave up to you guys at Old Capital to help me with. And so it really took a lot of the anxiety out of the second deal, and it really helped smooth out the process.
James, I probably would think the first question was to the seller, is this loan that you currently have able to be paid off?
In fact, it was. That's right. Absolutely.
Yeah. So sometimes, going through a transaction that does not close, it goes on your checklist to always ask that question on every future deal. So
maybe that's a good thing for people that are listening in the podcast, is make sure that you don't have a dry run, so to speak, and that you ask the seller or ask the seller's representative, does this property have a loan that has a defeasance penalty, that has a lockout, or does it have a prepayment penalty that people cannot pay this loan off, that somebody has to assume it? This happens every once in a while. This doesn't happen just to Dustin. We had a transaction last month where the seller just right at the end said, oh, by the way, this loan that I have has to be assumed. And we were like, what? Everything that was told to us prior to you telling us this right now said that we were going to be able to take this property down free and clear, which means that not we're going to pay for it in cash, but we can put new debt against it. And the answer came back from the seller, no, I have to have you assume this loan, because if I don't, it's going to be a $400,000 prepayment penalty on the deal. So that kind of threw us into a tizzy, what could be done. So it's not uncommon, but it does happen. So make sure you have the seller, again, verify that new debt can be placed against the property. And even on Dustin's deal, during that lockout, he couldn't have even have assumed the loan. Is that right, James?
That's right. That's right. So it goes back to an old underwriting saying, trust but verify. So I think a lot of people in this business, there might be 10, 15 people working on a transaction. Everyone thinks that everybody else is doing it. Everyone else is checking it. But always ask that question one more time. So let's jump into your second deal and how, number one, you decided to start looking outside of DFW.
Sure. So I live here in Dallas, and let me just start by saying I love competition. It makes us all sharper. It makes us underwrite better. It makes us all really perform at the peak of our game. Now, as I'm part of a mentorship group, there's several different mentorship groups here in Dallas and Houston, and there's a lot of focus on Texas right now. So that means there's a lot of interest and there's a lot of bid activity, and there's a lot of folks buying apartments around here. So what happened that really kind of pushed me outside of Dallas, the last property that I was in best and final on, there were 10 of us in best and final, and 5 of us were from the same group. And I said, and after finishing a close second, I kind of looked at myself in the mirror and said, maybe I need to look somewhere else. I think I'd have a better chance looking outside. Now, this goes back to my day job I was describing earlier. We had hired a new sales rep in the Phoenix market, and I was spending a good bit of time out there training the new sales rep on how to sell elevators in that market. With that, I had to get a pretty good basis level of knowledge from that Phoenix market. And when the fundamentals there looked pretty well, I decided that maybe I should call some brokers and look at some properties as well.
Okay. How did you find this property that you eventually got under contract?
Well, I was calling around on several other properties that sparked my interest there. And although the first couple didn't really make it to the point to where I could put in a letter of intent, I was spending a lot of time speaking with brokers and establishing some rapport. Also, some property management companies. One in particular I was working very well with, and they also have a very good local reputation. So when it came down to it, one of the brokers from one of the companies that I was working with out there gave me a call back and said, hey, I need you to take a look at this property. It seems to fit your criteria. Why don't you underwrite it and let me know what you think? So I underwrote it. I called the property manager who I'd been speaking with out there. He agreed to tour the property for me. He came back with very positive reviews. I spoke with the broker again, made sure that everything lined up. My questions were answered, such as, can the seller actually sell this property? Can we have new debt on this property? And lo and behold, I put a letter of intent in for this property.
Okay. So you got it under contract, and then what type of debt were you looking at on this deal?
Well, if we can, before we get into that, just getting it under contract in Phoenix was pretty interesting. They didn't know me. I mean, they've talked to me on the phone, but I'm not a known commodity out there, right? I'm an out-of-state buyer. I don't live there. I don't own any property out there. So in order to get the seller to accept my letter of intent, I had to jump on a plane on a moment's notice, fly out there, meet him, tour the property with my property management company. And clearly we had spoken before this moment. So it was clear to the broker that my plan of action for taking over the property was well established. My vision for the property was clear to the property management company, and we're all on the same page as far as what updates needed to be done, how much we were going to spend, where we could take the rents, and everything else. So from that standpoint, the broker felt comfortable. And then I had to call in some favors from some local friends, because the broker, even though he felt comfortable with me understanding the business and my underwriting, he still didn't know who I was or what I could do. So I asked my mentor to give him a call and explain the ecosystem of the investing group that we have. And that's Brad Sumrock. As a group, just in 2016, we've closed something like 30 properties and $260 million worth. So there's money within the group to close, and closing has never been an issue. And I wanted him to make that very clear to the broker so that he felt comfortable that as a syndicator, we would get the money. And then I asked the godfather of DFW lending here, Paul Peebles, to call him as well. Whatever you told him, after that phone call, he called me back and said, you're good to go, no problem. It was a non-issue after that.
I don't know about that.
So after those phone calls, and this goes back to the team concept, right? This is not a one-man sport. This is a team. And I would never have been able to get that property under contract if I hadn't had my team already set up. The property manager locally in Phoenix, you guys as my finance folks here, and my mentor here locally as well that could make calls for me.
Yeah, it's just really you're looking for the transfer of credibility. Since Dustin didn't have ownership in the Phoenix, Glendale, Mesa, Arizona market, they really didn't know him very well. Now, we've done transactions in the Phoenix market, and they know a little bit about us, but we do a tremendous amount of business in Texas. And so when I did make the call, I made sure that they knew that we were the real deal, that we could deliver the transaction, because every seller is looking for transaction execution and certainty to the deal. And so we do a lot of business with that listing brokerage company in Texas. And we just gave them a sense that we were going to be part of the transfer of credibility, and that we knew that Dustin was able to close. So it wasn't really a question at all in the seller's mind that this thing was not going to happen. James was part of the transaction, and of course, he's one of the best. So
a lot of times these listing brokers, they're your sales guy to the seller. And so we're trying to give him as much ammunition that when he brings your offer in, that the seller will accept it. So I think not only talking with, so this one I think was CBRE, was a listing broker.
Yes.
And then not only bringing in other listing brokers that we've closed deals with in Phoenix and giving them a comfort level with other properties that we've closed probably in a 5-minute radius of that property, got him comfortable in terms of lending as well.
that's great. But again, you spend a lot of time on Phoenix because you're trying to teach this new employee a little bit about the elevator business. How familiar were you with Phoenix at that period of time? Very much? A little bit? Did you just pick up the phone and call the broker? Is that how that worked?
Actually, yeah, that's exactly what happened. I was pretty familiar at that point because I had been spending so much time in Phoenix working with the new employee. So as we were learning the market together, like I said, it became clear that I should also invest in this place. And then I started making calls to brokers.
And so when you saw this property and sort of walked it, what were sort of the top 2 or 3 things that you liked about the deal that made you want to buy it?
It was a 1985 build, so it was fairly recent in apartment terms. It was in overall good shape. There was not a lot of deferred maintenance. It's Phoenix, so humidity is not an issue. Mold is not really a problem out there. Buildings are preserved very well. So from that standpoint, there was not a whole lot of exterior deferred maintenance that needed to be done. The only real play here was an update on the interiors and raising the rents to market level at that point.
James, telling me a little bit about that, because we talk about age of properties all the time, and we're in 2017 right now, and you think these are fairly new properties, but if you go back 30 some years or 35 years in the 80s and maybe the 70s and the 60s, why would somebody prefer an 80s product these days?
I mean, a lot of the, CC minus product, they're going to have aluminum wiring, they're going to have a flat roof, they're going to have a boiler, a chiller, all those mechanical items, and they might have older plumbing and older electrical panels and aluminum wiring, like things like that. Just the list just adds up. But once you get into 80s product, you might have pitch roof, you might have individual HVAC, individual water heaters, copper wiring, 8-foot ceilings, maybe 9-foot ceilings sometimes. And so it really allows you to upgrade the interiors, and it almost looks like a 90s, 2000 construction deal. So,
and that's the exact point that I want to make, is that the 80s almost look like the 90s and 2000s, where the 60s and 70s really remind you of the 60s and 70s for one. But I tell you, the higher quality assets, probably the best assets, were built in the 20s and the 30s, which is really amazing. But if you're looking at the 60s and 70s, that really is C minus property. So tell us some of the amenities on this property. Does it have a pool?
It does have a pool. Now, it is only a 70-unit property, so there's not a huge amount of amenities. In fact, that they pretty much stop right there after pool. There is covered parking, though, so I guess that is an amenity as well. But it's a very clean, simple property. There's not a lot of green space. In Phoenix, green space means high water bills or something like that. So there's really none of that happening either.
Any idea why the seller was selling?
The seller was selling, as I understand it, his father owned and maintained that property. His father passed away, and he was a businessman who did a bunch of business in San Francisco, remodeling commercial office space or something. So multifamily was not his gig. Okay. Very sharp guy, but just it wasn't his forte, and he didn't really want to mess with it. So it was time to sell.
Okay. And maybe walk through some of the numbers and give us a little bit on how this deal size up in terms of financing and how you went about raising the equity for the deal.
Sure. So financing, it was a $4.5 million deal, 70 units, puts a price 64 and some change a door, which for Phoenix is a very solid deal. Financing, we ended up doing 80% loan to value. Freddie Mac small balance loan came in at 4.55%. If I recall, it's a 10-year loan with 3 years interest only. So that interest only period really allows me to juice the returns for my investors. And so they're going to be realizing some excellent returns as this property really gets stabilized and running the right way.
Okay. And then so on the non-recourse Freddie, I guess how did you qualify for that loan if this was your first deal?
Well, I was a key principal on one of the other investments, which was a rather large property up in Ohio. That was a Fannie Mae loan. I believe the loan was about $11 million. Okay. So as a key principal on a Fannie Mae loan, that puts me in the Fannie Freddie Club, and I believe that allows me to qualify for a $3.6 million Freddie Mac loan.
All right, James, explain what the heck that means.
So it helps for sure. So Freddie Mac has the small balance program is a little bit more flexible. So they allow first time investors to buy a property, but typically they still need the net worth, the liquidity, and third-party property management. So in combination with your previous experience and your other KP's experience, that allowed you to acquire this property with a Freddie Mac loan.
But he lives in Dallas and the property's in Phoenix. How tough was that for you?
Almost every lender wants the buyer to be local, but if the buyer can't be local, the third-party property management, how many units does your property management company manage in that area?
Just over 3,000. 3,000
units. So they would rather have the property management company be local and have experience than Dustin be local and have experience.
Yeah, so what you're saying is that they put a lot more credibility in the property management company than they do in Dustin. Dustin, lives in Dallas, the properties in Phoenix, the property management companies in Phoenix. They manage 3,000 doors. They like Dustin, but they love the property management company.
They love the property management company, and they love that it was 95% occupied when we closed.
Yeah. That's good. That's real positive. Now, tell me a little bit about, was this property always 95% occupied after Dustin had signed the LOI, or was there some challenges on that?
So once we got under contract on the property, I think there was a couple, not only, so we were under contract sort of middle of 2017. And right, then May. In January, there was a change in management, or February?
They had multiple changes. I think the big change happened in February or March or something like that, where they had the local manager quit at the property and their regional manager quit at the same time. So it was total chaos for a while.
Okay. So a lot of transactions, we're looking at a T3 on income and a T12 on expenses. And when management companies change or the property management changes, the T12 is really, a bunch of T3s and T1s and a bunch of different numbers. And so we sort of had to put those statements together to make it make sense for Freddie Mac. And then also the interpretation of those statements, depending on who you asked, you got a different answer. And so the categories that they used were not very straightforward. It wasn't a typical property management company. It was, self-managed. And so it...
Self-managed. All right.
So, we would get a statement and it would say, net rental was one thing, but it was another thing. And so depending if you ask the leasing agent who put the numbers in or the regional manager or the owner, you got a different answer. So it took us a couple months. I think it was maybe a 30-day extension on top where...
Right. About that.
And maybe talk about when you were negotiating the contract. Do you remember what you put in the contract?
We got really lucky where we were able to insert a phrase in the contract that insisted that occupancy stay above a certain level so we could qualify for the Freddie Mac loan, since Freddie Mae and Freddie Mac want at least 90% occupancy during, I don't know, the last 3 months, or at least while it's under contract. I made sure to stick that in the contract. Good news is the seller signed off on it, and we were able to lean heavily on that phrase so that we got the extension without too much trouble at all.
Right. So I think the initial contract was probably 60 days. And then we got there. The last 2 months were below 90 and collections were down. And so we were able to push for an extension and get, I don't know, another 30 to 45 days for collections to come up. And then we were able to get, because I think at the time, if we had to close and you didn't have that in the contract, we would have probably been at 70 to 75% loan to value on the deal. And so, extending.
What kind of a solution do you have when the property's at 70% occupancy?
Sorry. The LTV would have been 70%. Yeah. So the occupancy didn't drop that far. It was just the collections had dipped. And so we were using it was a declining collection situation. And so they were having to annualize that, that last month really. And so that was cutting into the leverage instead of 80%, which we thought we were going to get. We were closer to 70%. And so Dustin was able to get an extension on the deal. And so we were able to get the collections up, get that number up so that we could get to the full leverage of 80%.
That makes sense. Okay. I understand.
So maybe talk about sort of once you guys close the transaction, how's it? So it's been 3 or 4 months now. Talk about sort of that process of taking over the property and what you've done so far.
Sure. So we closed in early September. And I've made multiple trips out to Phoenix to take a look at the property, to work hand in hand with the property management company, just to ensure that my vision of the property was very well aligned with the property management company's vision of the property. So with that, I have weekly calls with the regional. Since I'm not local, I can't just stop by there once a week and say, hey, you know what, the sprinkler's not working around unit 15 and, blah, blah, blah. I can't do that. I have weekly calls with the regional where we run over certain fundamentals of the complex just to make sure things are running in the right direction, or they're moving forward at least. In addition, it's just lots of communication, over communication, if you will, whether it's text messages or emails or phone calls. We have our standard once a week phone call, but that doesn't mean that I'm not going to call earlier in the week and ask about renovations in unit 212 or something like that.
So how much rehab are you planning on doing on this property? And then did you raise that money up front?
I had allocated about $300,000 worth of rehab, and I did raise that money up front through the investment group. So what's nice about the Freddie Mac loan is I have control of all that money myself. I don't have to do any draws from the bank for capital reserves or anything like that. Since I have control of that money, that allows us to act a lot faster, I think, than we would normally be able to act. So if we need to spend $10,000 immediately to do an extensive rehab on a unit that was heavily damaged, we can do that without having to wait for a draw or something like that.
Sure. How much of the 300 have you used so far?
Only about 35,000.
Okay. All right. Is that mostly interior turns that you're doing?
At this point, yes. We have done some light exterior enhancements, but it's mostly spent on interiors.
Why only 35,000? Have you been using any of the cash flow of the property to put into the property itself?
Some of the cash flow is being used, simply because we're using an account there local with the property manager. So any bills that come through, I make sure that it's a well-funded account. And then any immediate bills that they have to pay or any immediate costs that have to be spent, they have the money right there in hand.
Are you paying a dividend to your investors, and how many investors do you have on the property? When will you start paying?
There's 18 investors in the property, and I plan on paying the first dividend after the first full quarter of operations. So that would be January-ish.
Okay. All right. Now that you've got one under your belt, what does, the next 6 to 12 months look like for you?
Well, it's time to get another one under contract. Right now, I'm actively looking in the Phoenix market as well. I'm starting to look a little bit in the Carolinas. I like that market as well. So I fully anticipate that I'll have something under contract here Q1 of 2018 and looking for a next successful close for sure.
Similar size property or a larger property?
Looking to go a little bit bigger. I'd like to do 100 plus units 70 is a great size to start with, quite frankly, but I get a little bit better economies of scale with 100 plus. And, well, let's just say my operating costs are leveraged out between more units, so it makes a little bit more sense.
Any surprises since you took over the property? Anything that you didn't see or think of after you took over the property?
You know, the biggest surprise I think so far with this property has been getting rid of pigeons is not so easy. You can't shoot them, you can't poison them. It's very difficult. You have to put all kinds of little tack strips up and everything else. It just takes a long time to get rid of pigeons, and it's a lot more expensive than I thought it would have been.
What's attracting them to this property? Or is it just a lot of pigeons?
I guess at some point there must have been some trash hanging around, and now they're just there. And getting rid of pigeons is not as easy as you would think.
All right. Besides taking care of pigeons, what advice do you have for the multifamily investor out there who's looking to get into their first property?
Advice for your first deal, I'd say step number one, get educated on multifamily investing. That would be probably, I would suggest joining a mentorship group. There's lots of investment groups out there with qualified mentors. Again, I use Brad Sumrock, and it's worked very well for me and our group. From there, line up your team. Make sure you have your finance folks in place. Make sure you have your legal folks in place, your property management in place, and have a very good idea of how that's all going to line up. So when you do get something under contract, you can hit the ground running, because when that clock starts ticking, you have to perform, and you got to make your dates.
Yep, 60 days and hard money on the line. Pressure picks up a little bit, right?
Oh, yeah. There's a lot of sleepless nights out there.
So if people want to reach out to you, what's the best way for them to contact you?
I think email is probably the best way at this point. It's Lapacka, REI, at yahoo.com. Again, Lapacka being LAPACKA, REI at yahoo.com. I'm also on Facebook and LinkedIn. You can find me there.
Is there anything that we missed here that you want to leave our audience with? Maybe either more words of advice or just anything that we missed here?
Not that I know of. I think you guys pretty much covered it. Thanks for having me.
Yeah. Thanks, Dustin.
Well, Dustin, I think we've learned quite a bit today. I mean, we talked a little bit about your first transaction, how the deal was all teed up, and how it wasn't due to you at all. It was due to the seller that you weren't able to put that transaction together, but you learned a lot on the first one. I would probably agree with you that it was a dry run, but you learned a lot, and that definitely helps you on deal number 2. And now having deal number 2 under your belt, now you're on to deal number 3. So we're happy for you on that. And especially if you're thinking about either Phoenix, doing another transaction in the Phoenix area or in the Carolinas, and thinking about either 100 to 150 doors. I mean, that's kind of a natural pushing ourselves up to the next level of properties. We think that you're doing a great job. So we appreciate you coming in. We do appreciate your business. James, anything else coming up in the Old Capital podcast?
No, I think I do like the point that sort of going through the process, a lot of people will come to me and ask that they want to close a deal in the next 3 to 6 months. And I'll ask them, how many LOIs they've, put in, how many best and finals have they been in? And the answer is always 0 on both. And it's just going through that process of submitting an LOI and having the broker call you back and tell you you're $1 million short is good for you. So just get out there and go through the process of lining up your KPs, start building your database for equity, and start thinking about who you're going to use for property management and legal and things like that. And it'll make the process a lot smoother, and we can help you build that team. And so definitely give us a call and let us know what you're missing, and we can help you do that.
That sounds great. Some great words of advice from James. We appreciate that. Well, Dustin, thanks for coming in. We appreciate that. I'm Paul Peebles. That was James Zhang. Old Capital. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.